What's up, my friends? It's John Berruti from Berruti Success. Today we're going to talk about the new investor. That's right. So, my friends, today we're going to talk about being a new investor. What does that mean, John? What does it mean? What does it mean? It means this, that so many people that I've talked to over the years, both friends and customers and acquaintances, they all say they want to invest. But what's the problem? I tell them, what's the problem? Well, and they give you 9,000 excuses to Sunday. Why they don't start, it's too difficult, I don't know which provider to go with. These are all the excuses, and they're just excuses. That's all they are, right? So today we're going to talk about very simple, step by step, how to do it, which ones to choose. I will be honest, I'm with TD Ameritrade, and I'm going to explain later on in this video that I was hoping that you could auto-invest with TD Ameritrade, but you can't. You can do that with M1 Finance, and I'm going to list below this all the brokerage houses that I think are good ones. M1 Finance is one of the ones that I found that you can automatically invest every week, and it'll automatically readjust your portfolio, which is terrific, because the lazy investor is the smartest investor. And what do I mean by that? If you set it and forget it, just like I told you to do with savings. Savings, right? That's the whole basis of this. We're going to be saving every week, and we're going to be putting a portion of our money away every week towards investing. This week, I'm talking about ETFs, right? Exchange traded funds. It's the easiest way to start investing, and it's, I think, the smartest way to start investing. And if you ask Warren Buffett, who's super smart, he also said that if he passed away, he would hope that his family would just put their money into ETFs. What is an ETF? What is an exchange traded fund? Easiest way to say it, it's a basket of stocks. That's all it is. It's a big basket of stocks, right? And one of the easiest ones to follow is the Standard & Poor's 500. What is the Standard & Poor's 500? It's the 500 biggest companies in the market, right? It's the 500 biggest, and they compose of the Standard & Poor's 500. So ETFs like VOO from Vanguard invest in the Standard & Poor's 500. They follow it exactly. Exactly those 500 stocks, if they go up or if they go down, right? It follows them to the T. And that's a good thing, right? Because you don't have to be a genius. You don't have to pick the best stock. You don't have to pick, Elon Musk's beautiful companies. You don't have to pick Amazon or eBay. It's the 500 biggest companies. Are those companies in it? I believe so. Don't quote me. I believe most of them that I just mentioned are in the Standard & Poor's 500. But it's the biggest companies in the country. I don't believe in the world. I believe in the United States. Okay, so I have some notes over here, so you're going to see me glancing over because I want to, make this nice and simple for you guys. The first thing I want to say is, you talk to finance gurus, which I'm not. I'm just a normal guy trying to get you to save your money, to invest your money, to become a billionaire. I said millionaire, but maybe a billionaire. I don't know, bazillionaire, I like to say. Kind of molds them all together. They all tell you, pay your credit cards off first. I'm not that guy. I'm not going to tell you that. I know it's against everything that every financial planner tells you. Here's the problem. If I tell you you have to pay off your credit cards, right? Which is smart, don't get me wrong. If you have a lump of money sitting on the side and you could either invest or you could pay off your credit cards, my suggestion is that you pay off, depending on how much money you got, right? If you have $10,000 in credit card debt and you have $5,000, what should you do? I can tell you. First, $1,000 of it should be kept in savings as an emergency fund, right? Let's call it $2,000, I believe, should go towards your credit card debt, right? Where does that leave us? 3, 4, 5. So we got $2,000 left. And the $2,000 should go into investing like this. Why not spend the whole $5,000? Because if you took all $5,000, you still don't pay down all your credit card debt. Yes, it's high debt. Yes, you probably shouldn't have it. But here's the problem. If you don't start with the investing, right, you'll never do it. You will never do it. So my suggestion is do it slowly. Here's a better suggestion. Take most of that money and put it towards, I'm going to correct myself. Let's say $3,000 towards credit cards, $1,000 towards your savings emergency fund, and $1,000 towards to start to invest. I like that better. Okay, so you are paying your debt down faster, but don't put all of it towards paying your debt, because you need to start investing. You just do, right? And you need to be diligent paying down your credit cards, but it is a priority. But I'm going to tell you that I really truly believe you should start saving and you should start investing. Try not to get yourself in credit card debt, but those things are, investing is important. Okay. Why are ETFs better than mutual funds? Listen, if you're old as me, back in the day it was only mutual funds. So here's the biggest difference, right? And depending on what broker you go with, if it's a full service broker, they're going to try to, I don't know anymore, I shouldn't say this, but most of them try to push it towards mutual funds. Why? Because the broker makes more money. The fees are higher. So the biggest difference between a mutual fund and an ETF are the fees. You say, well, John, how much are fees? Listen to me. An average ETF, an average Vanguard ETF is about 0.25, a quarter percent, right? Your average mutual fund is over 1%, 1.25, okay? Let's say you invest, what I tell you to, at least $50 a week for 30 years, and you get back something like 8% interest, which is very, very conceivable, right? And you invest in the Vanguard funds, which again, they've gained, an average of 10% over the last several years. But let's say conservatively 8%. Over 30 years, you're going to save yourself almost $50,000 from that 1% that you're giving to that broker. You're going to save almost $50,000 over the 30 years. Now, over 30 years, it doesn't seem like a lot of money, but over 30 years, $50,000, it's going towards your retirement. It's going to be, do I get that new Corvette or I don't? You know what I'm saying? So the fees matter. So that's the biggest difference between an ETF and a mutual fund. Now, as far as ETFs, I prefer, and again I say I prefer, because I'm not a professional at this. You don't have to go with what I tell you. I am going to link them up in the bottom, right? Oh, I'm going to interrupt you. You know what you should do right now? I'm going to tell you. You should subscribe and ring the bell to help me on my channel, because this is what I like to do now. I sit, I talk to you, we have some coffee. I don't have coffee in my hand, but you have some coffee. We say hi, and you hit the subscribe, and you hit the little bell. It doesn't cost you. It's free. Remember, it's free. It's free for you and me, and it helps you and me. Well, it helps me, but it's nice that you would do it for me. Okay? So don't forget to subscribe. To the show. Sorry about that. So, I like Vanguard funds. John, why do you like Vanguard funds? I'll tell you. Their management is ingenious. Super smart people. Super smart people. They've been around forever, and their fees are ridiculously low. Average is somewhere between 0.5. I think the VOO, which is what I'm going to tell you to invest in, which is the Standard & Poor's. It follows a Standard & Poor's. I think it's 0.03%. Yes, 0.03%. Not 3.00%, which some mutual funds are. It's 0.03, almost free. The frickin' thing is almost free, right? A couple other funds that I really like is, and what I believe you should, listen to me. If you said, John, I want to start investing, I don't believe you should take a chunk of money right now and put it into the market. I do not. Look at me. Look at me. Look at me. I do not suggest that. Why? Because this stock market is out of control and it's insane. Well, John, if you're telling me the stock market is out of control and insane, why are you telling me to invest? I'm going to tell you why. Because if you take your $25 or preferably $50, hopefully $100 a week, and through M1 Finance, which I believe you can do, And the next video, I'm going to actually set up my M1 Finance account. So I'm going to set up an M1 Finance account. I'm going to set up with these Vanguard funds, and I'm going to show you how to automatically do it every week. I'm going to do that with the magic of the internet. I'm going to show you how to do it. This way, it'll walk you right through it. But I believe if you do that, and you do it in small increments, and you do it over your lifetime, it doesn't matter that it's super high right now. It's almost irrelevant, right? Because here's the key. Here's where the smartest investors make money, right? And this is how I have made most of my investing money, not my business money, not my real estate money, but my investing money, is not selling. Period. Not selling. Period. Not selling. Now, I know there's a ton of geniuses out there. Jim Cramer, love him, CNBC. He tells you to buy and sell and do. Yeah. Listen, I'm a buy and hold guy. And he said, I think it was a couple years ago, he said, listen, buy and hold is dead. Buy and hold will never be dead. And I'll tell you why. If you buy and hold great ETFs or great companies, right? And again, I'm not going to tell you to go out and buy GE or Ford or Amazon or Tesla. You can, but buying the S&P 500 and buying a couple of these other international funds, which I think you should do, and dividend funds, which I think you should do, over time, you're not going to make as much, okay, as if you pick the right stock. But who's going to pick the right stock? Who out of you is going to pick the right stock? I can't pick the right stock because I'm not smart enough. Have I picked stocks? Yes. Have they done terrific? Yes. Have I gotten dogs? Absolutely. Have I been screwed? 100%. And that including within the last 2 years. Luck Coffee from China. That one hit the pooper, right? I follow YouTube guys. This one guy, Joe, I'm going to forget his name. It'll be underneath here. Good guy, Bowtie Nation or whatever. His name will be underneath here. And a guy you should follow, smart guy. If you want to do individual stocks, he does a tremendous job, this guy, on doing the research and stuff. So I like this one, Luck Coffee from China. And I invested. It was a couple $1,000s. And I basically almost lost it all. Why? Because it was China, and they had some ridiculous accounting, whatever. I lost most of it. Now, if I only did that, right, would I have lost, like these people that put all their money into all this stuff, like what's going now with GameStop? Really? Really? Listen, this stock market stuff, this investing stuff is not the hottest thing of the day. That's not how you're going to get rich. It's not. No matter what anybody tells you. Day trading. Listen to me. On day trading. It is almost a guarantee that you will lose money with day trading. It is. Go and look it up. The percentage of people that make money with day trading is like, I don't know, 0.01. It's ridiculous. How you make money? Investing in good companies, investing in good management teams and an ETF, and do not sell. So when the stock market takes that poop, which it will, in the next couple of years, you do not sell. You don't sell. You buy more of what you own. You buy more, which lowers your cost of that stock, right? The last March, I had Ford, right? And Ford's an okay company to own, but it went down to like, I don't know, $390 or $350. I put a poop load more because it's Ford. I knew they were coming out with electric cars. I knew Ford was going to be around, so I bought a poop load. You know what they were saying on CNBC? Ford's going out of business. Could they go out of business? Sure. 100 years ago when I started investing, I think I was 13, I bought Kmart. How'd that work out for me? It didn't, right? So companies can go out of business. Did I know what I was doing when I bought Kmart? No. Did I know what I was doing when I was buying Ford? Much, much more than I knew before, right? How much cash they have in the bank. What's their stable like as far as what kind of cars they're coming out, the electric cars. What's their cash situation? What's their P&E ratio? All those things I looked at and I said, you know what? Ford's still a good company. So I bought, and I bought more. Did I sell anything in the last traumatic drop? No, I didn't sell anything. And it's so hard. I'm going to tell you now, It is so hard when things are tanking and everybody around you, every TV station, every radio station,
everybody's going out of business. America's failing. It's the next depression.
they're all going to tell you that. They need to sell minutes. They need to sell you on the fact that please come and watch us. We're telling you everything's crashing. I want you to come back. I'm CNBC. I need you to watch me, right? The reality is, can it happen that we go into another national super depression? Yeah, it can. And you know what came out of that depression? Multi-billionaires. Because the people that knew what they were doing, right, as the depression was going on, they kept buying and buying. And some of them were buying companies. And some of them were buying physical companies. And some of them were buying stocks. All the people that lost money, they sold. Or they bought crappy companies to begin with that were a joke and they went out of business. But that, my friends, that is the biggest thing. You don't panic. You buy great companies, great managers, and even through the toughest times, especially through the toughest times, you keep buying. So if you're buying at the high right now, and you keep buying and just make it automatic every week, $50 every week. Let's say you do, you're saving $50 a week, like I tell you to, and 25 is going towards your investment and 25 is going towards your savings. That $25 a week, if you keep buying, over time, it doesn't matter. If you look at all the charts, right, they all eventually, even though they dip, they go back up and dip and go back up. And that's what you have to bank on. And that is history. And history is the side you want to be on. Okay? Very simple. What else we got? Okay, now, as far as the platforms to trade on, and I say trade by buying your stocks, you can go to Vanguard directly. And I believe it's a couple of, like, very tiny percentage. I think you get a little better deal going through Vanguard, but here's the problem. You can only go through Vanguard, their portfolio. So their mutual funds and their ETFs. You can't buy anything else. You want to buy GE? You can't. You want to buy Ford? You want to buy Fiat? Nope, can't do it. Tesla, all those things. You can't do it through Vanguard. You can do it through their funds. You could buy a fund, but if you want to buy an individual stock, it's not the way to go. So I started doing some research. I called Ameritrade and I said, hey, listen, this is what I want to do. Because I've never done it before, because I've always, not automatically, but I've always bought my own stock. So I didn't automatically set it up. I've automatically set up my savings, but I never automatically set up my investments. So I call them like, this is what I want to do. Oh, we don't do that. What? Yeah, we don't do that. What are you talking about? Yeah, we don't do that. Okay. So I started looking. M1 Finance. I have looked at it several times. I don't like having multiple platforms because it's a pain in the ass tax-wise and all this, but I'm going to, M1 Finance allows you to do it. And I'm not sure exactly how they allow you to do it. I believe you put in your pie, which is all the things you want to invest in. Let's say it's individual stocks, but I'm telling you, I'm going to explain to you which ETFs I think. I'll tell you right now. So VYMI, right, which is Vanguard's International High Dividend Yield, right, which is, again, high dividends. Are you going to make as much over time with growth? No, these are steady companies that pay out a dividend. And the average dividend in these, excuse me, in these international funds, I believe is like 6%. Is that a ton of money? No, but it's safer, and it's diversified, international, right? And you keep getting the dividends time and time. The growth is not as high, but the dividends are steady. It's a great way to go. The other is the United States high dividend, which is and again, I'm going to link all these up below. You can just click on them and it'll bring you right to them. VYM, which is Vanguard's high dividend yield fund. Okay. And then the one I said before, which is VOO, which is their Standard & Poor's fund, which follows the Standard & Poor's exactly. There's some others. We'll go next couple of weeks. We're probably going to go over REITs, which a REIT is a real estate investment fund, which I believe to diversify. I'd like you to buy REITs. I'm not sure if I don't invest in any Vanguard REITs, but I'm not sure. I believe they have one. I'll look into it and see how good it is. But I haven't, all disclosure, I haven't invested in it. Maybe when I do the M1 setup, I'll do that. But there's a lot of different things to getting back to the start of this for the beginner investor. These funds are terrific, right? Low investment. You don't need thousands of dollars. I think the average is somewhere between $100 and $500 that you have to start in some of these. And if you're doing it through a broker, I believe the minimums are actually even lower. They might even be $25 or $50, and I'll make sure I check that out, right? Your expense ratios, what it's costing you every year to hold this, is super low. Like I said, VOO is 0.03, which is absurd, right? So I think that's everything I wanted to get through to you guys this week. Yep, that's it. So let's recap, right? Beginner investor, what should you do? Well, you should start paying down your debt, no doubt. But no matter what, you should start investing, right? Do I believe you, if you have $1 million, should you invest it all once? No, not in this market, absolutely not. Do I think you should take a small portion every week and start an automatic investment portfolio? Yes, I do. And why do I? Because here's the thing. Can the stock market go another couple hundred points, never a couple thousand points? Sure. Can Tesla go up another 100, 200? Yeah. Can Amazon? Sure. Can GameStop? Whatever. Yeah, whatever. But yeah, these stocks can keep running, right? And you'll buy them as they run. And if the stock market takes a super crap, which I believe it's going to do, you're still buying every week. So it's going to average itself out. You bought high, you bought low, it'll average itself out. And that's the beauty of dollar cost averaging, to put a little bit in every week. Okay, so I hope you got a lot of value out of this. If you have any questions, please don't hesitate to ask. Ask in the comments. I love if I don't know, I'm going to tell you I don't know, and I'm going to try to find out for you. Remember, I'm not a licensed broker, right? I did study finance, but all this is just my information. I'm trying to help you. So always double check with your accountant. If you have an investment advisor, double check with them. This is basic advice, okay? And that's for the beginning investor. Hope you got value. I'll see you on the next one. So hopefully we get this right with our new laptop version.